Schiff, an economist and gold fanatic, frequently has a lot to say. Schiff stated in an interview that he thinks the United States will experience a financial catastrophe worse than the Great Recession of 2008. Since the United States now owes a lot more money than it did in the past, according to Schiff, the economic downturn in the country is going to be a far worse problem when the defaults start. During this market meltdown, the majority of investors haven't even bothered to peek beyond the surface. Thus, they are completely unaware of the massive rotation that is already in motion. The introduction of inflation will result in a fundamental shift in the financial environment, drastically altering the dynamics that have prevailed for investors over the past 10 years. Basically everything that has worked. This bubble was being inflated by the Fed, but it won't last since air will eventually escape from it. Despite the Fed's best efforts, we believe they have already popped the bubble, and there is virtually nothing the Fed can do to stop it from popping. Let's start by addressing the first part of the stagflation equation, which is that we certainly have a major inflation problem that has endured for more than 10 years. Inflation hasn't manifested itself in a way that was problematic for the Fed or investors because it was raising asset values rather than consumer prices. Consumer prices increased, but not much enough to raise alarms, especially given the government was able to mask the true rate of price growth using the SPY, which Peter believes intentionally does a poor job of correctly representing what's happening in the market and materially underestimates the pace of price growth. Due to the Fed's capacity to continue inflating under the pretense of quantitative easing, stimulus, and 0% interest rates. The government's ability to pretend that inflation was below 2% allowed the Fed license to do so. However, this money mostly went into financial assets, while also contributing to a record rise in the U.S. trade imbalances. In fact, we learned that the trade deficit in December set a new record of $101 billion, making it the first time that the trade deficit exceeded $100 billion. For the entire year, our trade imbalance in products exceeded $1 trillion, an amount that has never before been attained by any country. These are goods traded for merchandise. Even though we experienced a 7% increase in consumer prices, according to how the government monitors inflation, a portion of that actually helped keep the price of goods under control. If our trading partners had not pushed $1 trillion worth of goods onto our market, just think how much higher consumer prices would have risen. How did we pay for everything? Exactly, we didn't. The products that the rest of the world created were exchanged for the money that we printed, and Americans didn't even make a lot of the money that they spent. The government just provided it to them in the shape of stimulus payments or other rescue funds. And from where did that originate? Well, it was printed by the federal government. When we initially entered the pandemic March of 2000, we enacted the worst conceivable blend of monetary and fiscal policy because instead of acting appropriately and cutting the money supply with the economy so that demand would decline along with supply, we did the opposite. The Fed and the government worked together to create the worst monetary and fiscal policy in human history. Everyone received checks in the mail from the government to replace their paychecks. But the important thing to remember is that when you earn a paycheck, you are being productive and aiding in the production of goods and services. As a result, you are rewarded with pay and can now enjoy some of the goods and services that you assisted in creating. Less consumption is necessary when you are not working. However, the government did not want that to happen because it would have meant worsening the recession. Therefore, it shouldn't have come as a surprise that there are severe shortages now that the government has paid everyone money to spend on goods and services that they weren't generating. We had all this extra demand because of the government and the Federal Reserve, and we haven't even started to feel all the effects of that inflation. It is an evident result of a failure to create when there is a lack of goods. Peter believes that a substantial portion of the inflation that we saw in 2021 was a delayed effect of the inflation that occurred before 2020. I don't even think we've caught up to that inflation yet, which is one of the reasons that we're going much higher. Not only wasn't inflation transitory, but it's going to be far higher than it was during that supposed transitory period. I said the Fed was lying about that. I said that inflation was as transitory as the subprime market was contained. In 2007, when the subprime market exploded due to the mortgage market, That is exactly the falsehood the Fed told us. The damage was restricted to one niche of the mortgage market, the Fed assured us, and so there wouldn't be an issue. The housing market as a whole would not be impacted. It wouldn't have an impact on the economy. And of course, the 2008 financial crisis happened. The Fed continues to intensify this inflation issue since it is actually adopting a more stimulative stance while appearing to tighten. However, if inflation gains momentum, which it will most likely do, real interest rates will be falling even as the Fed marginally raises nominal interest rates. The main issue, however, is that the Fed was only able to defend these unnaturally low interest rates and quantitative easing on the grounds that there was no inflation, which gave them the freedom to do so. The Fed can no longer support keeping interest rates artificially low since, even if they raise them by 2%, they will still be low given that inflation is now triple or more than 2%. Since our massive debt bubble was the only thing keeping us afloat, the Fed could only maintain rates at such low levels. The financial crisis would be much worse than it was in 2008 if interest rates were allowed to return to normal. All of the large banks that we bailed out would fail. There would be a stock market crash. If the Fed allowed interest rates to reach a natural level, the real estate market would implode, and the private sector would struggle to pay its debts. The United States government would likewise find itself in a difficult situation, possibly worse. It would be necessary for the U.S. government to make a national debt default. In actuality, the federal government is in a difficult situation. Fighting inflation while allowing interest rates to rise and everything to fall is a poor decision. The worst course of action would be to keep inflating in order to prevent that and delay the effects of hyperinflation. But regrettably, that is probably the decision they will make. What should investors do in light of this new reality given that, despite the Fed's continued provision of cheap funds, those funds won't be sufficiently low to maintain the bubble, which is already losing air due to the Fed's recent announcement of minute rate hikes? The bubble has already burst. Many of the equities from the boom are already down by 50% or more, and they will keep declining. Even more so if you look at value stocks, we are currently witnessing enormous rallies in dividend-paying stocks in Europe and Asia, stocks that have been written off for years, and equities that were exploited as a means of raising money. In an inflationary market like the one we're in with firms that trade on a dream, high PEs, or no E's at all, people are now picking up those stocks as they sell off these overvalued assets because they can't get out of overpriced U.S. equities right now. As a result, people sell these equities since the impetus is past, and they only trade on anticipation and hope. So what happens after you exit overvalued U.S. stocks? You must invest in international stocks that are underpriced, since doing so basically enables you to achieve two goals. You should sell your U.S. stocks and put the money into higher valued companies that are profitable right now by making and selling products, making money, and paying dividends. As soon as people realize that the Fed is helpless to stop inflation, which will continue to depreciate the currency, you should sell all of your U.S. dollars. The true cause of this recession is inflation, which will raise living expenses to such a high level that Americans will spend a significant portion of their disposable income on items such as food, energy, rent, insurance, and healthcare. They won't have any money left over for discretionary expenditure, which will result in joblessness for those who depend on that sector of the economy for their livelihood. You must dump the currency and invest in inflation-hedged securities. The prices of gold and silver will undoubtedly increase significantly. Peter predicts that we will experience another leg like the one from 2001 to 2011, when gold increased by nearly 5 times. It's very likely to occur once more. Ignore tech stocks. They are outdated. They were successful in the past, but they won't be successful moving forward. What worked in the 1970s will still work today. The inflation will increase significantly, since we can't raise interest rates because the government is insolvent, which was not the case in 1980. The economy will be significantly worse than it was then, and regretfully, we won't be able to stop it as we did. In 1980, when we were still a wealthy creditor nation with trade surpluses and low debt to GDP ratios, America was the exact opposite of what it is today. But this time, according to Schiff, the country's banking behemoths won't be bailed out. The economic experts said, when they fail, it's going to be a lot worse, except with inflation too high and the Fed fighting inflation. There's no TRP 2.0. All these banks are going to have to be allowed to fail. What do you think of Peter Schiff's views and comments on the economy? Do you believe Schiff will be right in his forecasts, or do you believe he will be wrong? The content in this video is for entertainment purposes only and hence should not be considered financial advice. Do conduct your own due diligence and consult your financial advisor before making any investment decisions. With that, we have come to an end. See you in the next one.